Welcome to Finance Depth. I'm Abhishek, and today we are going to start a new series on stock market. As the first video, I'll be doing what is stock market, and I'll do a follow-up video on how to start investing. So do subscribe to the channel and don't forget to hit that bell icon so that you'll be notified whenever I upload a new video. And if you have any questions or doubts, do let me know in the comment section below. Or if you want to have a detailed discussion, then you can join the Discord channel below. I'll be giving the link in the description. And without further ado, let's get started with the video. So before understanding what is stock market, right, we have to understand what is a share. Let us say there are two friends, Ramesh and Suresh. They decide to start a company. They pull in 1 lakh each, that is a total of 2 lakhs capital. Now there should be a way to understand how much ownership each have in the company, right? For that, there is a concept of shares. Let us say when they start the company, they have allocated 100 shares. You can allocate as many number of shares as you want, and you can increase the number of shares later also. For the sake of simplicity, I have taken 100 shares. Since they have pooled in equal amount of money, both will get 50-50 shares. Now Suresh owns 50% of the company and Ramesh owns 50% of the company. So that is what the concept of share is. Now tomorrow they want to raise some money. Let's say they have a friend called Rakesh who sees that the company has grown and also sees some potential and approaches these two folks and says, I want to invest also. So now what they will do? So they agree to take the investment, and as a return, right, they will give some of their shares to Rakesh. So let us say each have given two shares to Rakesh. Now Rakesh will have four shares or own 4% of the company, and Ramesh and Suresh each will own 48% of the company. As you're seeing, right, the shares of Ramesh and Suresh, who are founders, has reduced here. So whenever a new capital is raised or money is invested in the company, the existing shareholders or investors will lose their shares. So that is how the concept of shares work. Now let us see how one can invest in a company. There are different routes in which you can invest in a company. One is private capital, and these are the different ways in which you can invest in private capital. First is bootstrapping. That is what we have seen in the earlier example where Ramesh and Suresh pooled in their own money and invested. In bootstrapping, what you usually do is whatever revenue or profit you get, right, you will reinvest that into the company. Next is angel investing. Usually, popular celebrities or who can market your company will come and invest. Then there are different ways in which you can raise private capital like seed funding, venture capital, private equity. I'll do a separate video on private capital. I'll not go into details in this video since this is more related to stock market. And second way to invest in a company is primary market. That is, let us say you have exhausted all these ways of raising capital and you want to raise more money. Then what you can do is you can list your company in the stock market. The process of listing the company in the stock market is called as initial public offering or IPO. Again, I'll do a detailed video on IPO another day, and there are other ways also in which you can raise money from the primary market like FPO, rights issue, QUIP, and so on. And the last way to invest in a company is via the secondary market. That is, you'll be buying shares in the secondary market, and exchange of shares will happen between different traders. The company will not be involved. That means the money will not go to the company. The money will go to the people who will be selling you the share. So before seeing the process of buying a share, let's understand different entities in the secondary market. First is the investor, that is you and me who want to buy the shares of a company. And next we have brokers, that is like Zero the Group and others, where investors can go and create a demat account and buy shares or sell shares of a company. And there is exchange. Mainly in India there are two exchanges, NSE and BSE. NSE is the most popular exchange and BSE is one of the oldest exchange. Exchange is where the share exchange or the trading happens. Then there is clearing corporation. The duty of clearing corporation is end of the day they ensure that the buy and sell are settled and fund moves from the buyer to the seller and the shares move from seller to the buyer. And then there is depository. Depository is where your shares are held in dematerialized form or demat form. In earlier days, the shares used to be held in paper format. You might have seen your grandparents or parents saying that I have shares of this company and showing you paper. Now it is all digital. Everything is stored in demat form. SEBI is the regulator who creates all the rules, and they change the rules on a periodic basis and monitor everybody is playing according to the rules. Nobody is doing any foul play. Now let's see how a share purchase happen. Let us say there is a person called Rahul and he wants to invest in HDFC Bank. He cannot go directly to HDFC Bank and ask them give me your shares. They are not going to give you. So there is a process for this. So first you need to approach a broker to buy the shares. There are different brokers like Zerodha, Grow, etc. And it is not like directly go and buy from the broker. He has to open a demat account with the broker and follow the KYC process and add funds to the broker account. Then only he'll be able to purchase the shares. So let us assume Rahul has done all those process and now he goes and says, I want to buy 10 shares of HDFC Bank. Now, what broker does, right? There is something called exchange. There are two main exchanges in India, NSE and BSE. Now, the broker goes to NSE and says, Rahul wants to buy 10 shares of HDFC Bank. Now, remember, for buying any share in the secondary market, there should always be a seller. And the other way around is also true. You cannot sell a share if there is no buyer. So the order waits in the exchange for a seller to come in. Now let us say Neha has shares of HDFC Bank she got through IPO. Now she wants to sell that. She goes to her broker, let's say Grow, and says sell 10 shares of HDFC Bank. Now this order goes to the exchange. Now the exchange matches these two orders because the quantity is same. So these two gets matched and the order gets placed. Now what happens after the order gets placed at the end of the day, right? After the market is closed. By the way, Indian markets are open between 9:15 a.m. to 3:30 p.m. After 3:30 p.m. in the evening, the broker sends all these buy and sell orders to the clearing corporation. Each exchange like NSE has its own clearing corporation and BSE has its own. So what Zero the sends, right? Zero the sends funds to the clearing corporation because it's a buy order. Rahul's money gets sent to the clearing corporation and Neha's shares get sent to the clearing corporation. What clearing corporation does, right? It says that it tells the depository move these 10 shares from Neha's account to Rahul's Demat account, and it tells the broker that you have successfully bought this shares, and that reflects in Rahul's Demat account next day, and Neha receives the funds the next day. So that is how the whole process of buying shares and settlement. Now let us see how does the price of a share increase or decrease in the market. Let us say you grow mangoes in your farm and you want to sell those mangoes. You have got about 5 kgs of mangoes, so you go to the market and go to a fruit vendor and ask him what is the price. He will say, I'll give you 30 rupees per kg. At the same time, your friend walks by and asks, oh, you're selling mangoes. How much is the price? You'll tell the fruit vendor is giving me 30 rupees. So your friend will say, why are you giving to him? Give it to me. I'll give you 40 rupees because anyways the fruit vendor is going to sell me at 50 rupees later. And you'll be happy and you'll sell to your friend at 40 rupees per kg. So this 40 rupees is the price of the mango. Or you can call it as last traded price because that is the price at which the mango is last traded. Now let us come to stock market. Let us say the last traded price of HDFC Bank is 900 rupees. Now let us say person A wants to buy 10 shares of HDFC Bank. He will send this order to his broker and order will stay in the exchange until an order to sell 10 shares of HDFC Bank is received. Let us say that comes now and now these two orders will get matched and the trade will get executed and the execution price will be the last traded price which is 900 rupees. Now let's say I don't want to buy at 900 rupees, I want to buy at a lower price. Is that possible to do in stock market? Yes, you can do that. You can do that by telling to your broker that I want to buy 10 shares of HDFC Bank at rupees 899. Now what will happen? This order will sit in the exchange until somebody is ready to sell it at 899 rupees. Now let us say you get an order saying that sell 10 shares of HDFC Bank. Now this will match and the traded price will be 899, not 900, because this person who placed the order has told his broker and in turn the exchange that I will buy only if the price falls to 899 rupees. This is how the price of a share falls. Of course, it doesn't fall directly from 900 to 899. It will fall in a smaller magnitude. I've given this example just for demonstration. Now we have seen this price, right? You are specifying the price as 899. This type of order is called as limit order. When you don't specify the price, that type of order is called as market order. Market order can get executed at any price. Let us say some illiquid share, that means there are very less buyers and sellers, and you go and tell I want to buy 100 shares of this stock and you don't specify the price, right? What will happen, right? When whatever the price the seller sets, right? I won't sell at very high price, then that will get executed and there is a high chance that you'll end up losing money. So whenever you buy a stock, right, always use limit order. If it is one or two shares of highly liquid company, it is okay to place market order. But if you're selling in huge bulk and it's a less known company with very less trading volume, then you have to put limit order. So we have seen how the price can decrease. Now let's see how the price can increase. Let us say there is some news about HDFC Bank which is positive in nature. Then what will happen? There will be a lot of people who will come to buy the stock, right? And naturally, everyone will say, I will sell my share at a higher price. They will not be ready to sell at a lower price because even the sellers would have heard that news and they want to benefit from this. And they will place limit orders saying that I will sell at 910. Then what these buyers will do? Okay, it's fine, 910, right? 10 rupees, I'll buy. Maybe tomorrow it will go up further, thinking that they will place buy order. Again, if this is market order, this will match and the order will get executed at 910 and the price will move to 910. The last traded price will be 910 and that is how the shares move up or down. I have opened my broker's account, that is Zerodha. It is their web application where we can buy the stocks. They also have a mobile application. You can go and buy or sell stocks there as well. Now I'll search for HDFC Bank. It will give you two options. You can see either NSE or BSE. I'll select NSE one and I'll click on this chart option. The chart will load up. I'll open this in a full screen. So this is HDFC Bank's last 1 year chart. So as you can see, right, it has been going up and down. So 911.85, that is the last traded price on Friday. I'm recording this video on a Saturday. And if you see, right, the share has gone up like around 10% in the last 1 year. So how this chart is drawn, right? At the end of the day, whatever is the closing price, right? They will plot a point and they will connect it and draw this chart. And whatever you can see here at the below, these bars are called volumes. Volumes are nothing but the number of shares that are traded in that particular day. You can see that volume here. So here it is showing 22 million. That is like 2.2 crore shares that is traded in the last day. So you can imagine the volume at which the trading happens. So in liquid shares like HDFC Bank, right? Whenever you click buy or sell, right, immediately the trade will happen. It won't wait for a long period of time in the exchange for the order matching to happen. You can change the interval here. You can go to 5 second and you can see the volumes here. It's around 2000 to 3000. That is how many shares of HDFC Bank gets traded every 5 seconds. So you can imagine the liquidity of the stock. In India, there are more than 5,000 listed stocks, including in both NSE and BSE. So if you want to understand what is the current status of Indian stock market, right, you cannot go to every stock and see its price, right? For that purpose, we have something called indices or index. For Nifty, the key index is Nifty 50. Nifty 50 is formed by constituting the top 50 companies listed in NSE and Sensex constitutes of top 30 companies listed in BSE. So how do we identify which is the top company? That is done through market capitalization. What is market capitalization of a company? Market capitalization of a company is nothing but the price that you will have to pay to purchase the entire company. That is the theoretical definition. Of course, practically you cannot buy the entire company. So there are two types of market capitalizations. One is total market cap and one more is free float market cap. We can get the total market cap by multiplying current share price with the total outstanding shares. Total outstanding shares includes all the shares which is tradable and non-tradable. Non-tradable shares are mainly with the promoters. And there is something called free float market cap. Free float market capitalization is the capitalization of shares which are available for trading in the exchange. You can go to this niftyindices.com, which is official website of NSE India, and you can download the fact sheet and check. So as you can check, right, these are all the top constituents of Nifty. HDFC Bank has a weightage of 12.3 percentage. ICICI Bank has a weightage of 8.38 percentage. This weightage is determined by the free float market cap, not by the total market cap. If you see the total market cap, right, the total market cap of Reliance is more than that of HDFC Bank, but weightage of HDFC Bank is more than Reliance in Nifty. This is because while considering the weightage, they consider free float market cap. And the reason why Reliance has lower free float market cap compared to HDFC Bank is there are more percentage of shares which are held with promoters in Reliance than compared to HDFC Bank. Now, what does this 12.3 percentage of HDFC Bank's weight mean? That means whenever HDFC Bank goes by 10 percentage, then the index will move by 1.23 percentage. That is what this weight means. This, of course, assumes that other shares do not move or their movement cancels each other. So, how do we determine what should be the index value, right? That was set to 1000 as a base value on November 3rd, 1995. That is for Nifty 50, and the index was launched on 1996. So as you can see, right, here is the chart from 1996 to till January 30, 2026. This fact sheet is published end of every month, and the rebalance calculating who becomes part of the Nifty and who goes out of the Nifty based on market capitalization, right? That happens once in 6 months. And as you can see, right, it started around 1000 and now it is trading around 25,000. So I can go to my broker and show it to you. I'll change this interval to 1 month so that we can see more data in this frame. So as you can see, right, around 1996 it was trading at 1000 points. Now it is trading at 25,000 points. That means had you invested 1000 rupees on 1996 in Nifty, it would have become 25,000 by now. Can you invest in Nifty? You cannot directly purchase an index, but there are ways in which you can invest in index. We will be covering that in the next video. Now, based on market capitalization, right, companies are divided into different categories. One is a large cap. Large cap constitutes of top 100 companies by market capitalization. They are well established and usually stable companies. Next is mid cap, that are companies which are ranked from 101 to 250. These are mid-sized companies with higher growth potential. And next is small cap. These are the companies which are ranked from 251 onwards, and they have a higher growth potential as well as higher risks. And there are indices based on sector like Nifty Bank, which tracks the banking stocks like HDFC Bank, ICICI Bank, and so on. And then we have Nifty IT for tracking IT companies like Infosys, Tech Mahindra, Wipro, and so on. And then there is Nifty FMCG, which tracks FMCG or fast moving consumer goods companies like HUL and Asian Paints. Then companies like Tata Motors, Bajaj Auto makes the Nifty Auto Index. Then there is Nifty Metal Index for tracking metal companies. So that's it for this video. Hope you all liked the video. If you have liked, please consider subscribing to the channel. I'll be uploading the next video on how to start investing. So please do watch that video as well. So see you in the next one.